Hey guys, my name is James Mason. In this video, I'm going to talk to you about what is dilution and how does it happen. So, dilution is when the company adds new equity shares onto the market. So when you hear about restricted shares and when the time frame is up for those restricted shares and those people choose to sell those shares, that is what diluting your stock means, because those people now take their shares and they dump it into the float. So it actually increases that float to where now it's going to take more shares to be bought to raise that price. So just for some simple math to make it easier to understand, let's say you and 3 of your friends, so total 4 of you each have 1 share of the company, and we'll just say that's the whole float. Well, then I come in and my 1 share, which was the restricted share, is now unrestricted to where I can dump it onto the market. So let's say that your 1 share is worth $100, and then I dump my share onto the market, which now decreases your share from $100 to $80. And it decreases like that because at first you and the 3 of your friends each had 1 share, and that was all that was in the market. Well, then I now put mine in the market, so it makes more shares available on the market, which now makes your share less valuable. So why would a company put more shares onto the market? It's to raise capital for them to operate in their business and to fill whatever goals that they may have. Or sometimes they pay their employees with the shares, or they will buy other companies, which that's what you call an acquisition. So the intention for this is to have the means to raise money, to take that money then and make the company more profitable. So I hope this helps you understand what dilution is a little bit better, and just some of the ways that it can happen. So please subscribe to my channel if you liked this video. Please give it a thumbs up, and I will see you in the next one.